Okay, folks, I've got 9 straight up. And so in the interest of your time, we'll probably get started now. This is going to be the 4th session out of obviously a 4-session period. This is the last one dealing with export financing and risk mitigation. The speaker today is Mr. Brent Hoots, who's the principal at Navitrade Structured Finance. And obviously he'll be talking about trade credit services. Kind of some housekeeping stuff. There's some information there for those of you who might be having some issues with your mic or your communication systems. I also want to make sure that you guys are aware that you can submit questions, and you can do so at any time by just going to the questions section down on your right-hand side. Be aware also that this is once again the 4th presentation out of the 4 sessions on this particular topic. And the recordings for all 4 sessions will be going out to those who participated within 48 hours. So that'll be coming, but it'll probably take a couple of days. The entire series is being sponsored by the Arkansas Manufacturing Solutions, which is a Department of Arkansas Economic Development Commission. Their mission is to assist manufacturers to maximize enterprise value by assisting them with innovation, operational excellence, sustainability, and leadership development. The District Export Council, which we're part of here, and I'm the chair of, there are 60 district export councils, or what we call DECs, throughout the United States, and with charged with encouraging and supporting the export of goods and services that will strengthen individual companies, stimulate U.S. economic growth, and create jobs. All righty, so we're going to have Mr. Brent Hoots start talking about export credit insurance, and I think you're going to find it extremely interesting. He's going to have kind of a story format, and I think it'll be very informative and entertaining. Brent?
Thank you, Rudy. Thank you so much. And I think Heidi is about to hand over control to me.
There you go.
Okay, fantastic. Okay, well, good morning, everybody. It's great to be here, and thanks for inviting me. My name again is Brent Hoots, and my company is Navitrade. More about Navitrade at navitrade.com. I'm a specialist niche broker focused on some very specific areas, in particular, trade credit insurance and political risk insurance programs. Export credit insurance also is for the international portion of that. And let's talk about export credit insurance today. And this is a strategic program that becomes interesting to my clients who are selling product and or services to an overseas buyer on unsecured terms. So we have a buyer in Brazil, we're shipping it down there, and we're extending net 30, net 60, net 90 or longer terms. We ship it and we expect them to pay us. So what are all the things that are going on for a company when we're shipping on open account terms to an overseas buyer? And there are lots of things happening for companies. And let's walk through that a little bit. And I really love to walk people through a story about a client of mine from many years ago. And the beauty of the story for me is that it is almost universally applies to so many of my clients, and I see these issues day in and day out. This is we'll call it a middle market to middle market, small size company, really well managed, a great management team, and doing great things. And at some point, they made the decision and really asked the question, you know, why can't we find another 5, 10, 15% additional revenues on top of what we're doing from overseas markets? And the answer is yes, absolutely. That's brilliant, and you're so right to be doing that and pursuing that. They were all about that, and they were invested toward that, and they even brought a person on board to head up the international function. And the whole team, we're going to see what the team's perspective, the management team's perspective was on where they were, but it was a great team. Everybody was good. They were seasoned pros. And really interesting in this story, nobody made any mistakes. This is a company that was all about best practices. And yet in the pursuit and getting going on the international side, They bumped into a lot of issues and problems, and it eventually became a bit of a quagmire, a bit of a mess, and people were very frustrated, and we needed to find solutions. We were introduced to them, and we ended up putting in place an Ex-Im Bank export credit insurance program, and we fixed pretty much everything for them. So the story is pretty dramatic, and it's universally applies. They're heading down this path, all about international, had problems, and then we were introduced to them by their banker, actually. The idea was we should stop by, strategize, figure out where they were, and hear about export credit insurance. So, so I'm not seeing my arrows in the lower left-hand corner, unfortunately. Heidi, sorry. I'm wanting to go to the next slide. Just a moment, we're almost there. Perfect, great, thank you. There, now I see the arrows, good, now I'm in control. So I was invited, I went to the company and we went into a conference room and sat at the table and I was introduced to everybody. And for me, this was a great day and a really good meeting about to happen because we had several key people there. It was like the perfect group to talk to about where they were and how we were going to strategize about export credit insurance. So we had the head of international, the credit manager, the CFO, the CEO, all really great at their functions. The meeting started off with the head of international. She had been in a couple of other companies, was really great at international. And she proceeds to talk to everybody and, and explains, well, look, you brought me on board to pursue international for the company and we're doing it. So we really have a great short list of markets overseas that we think we should do really well. And Brazil in particular, Brazil is going to be really great for us. So we've been focused on Brazil, and our first issue becomes our market penetration strategy. How are we going to get into Brazil? How are we going to do that? And as is true for so many of my clients, the best market penetration to start off with is to find a great distributor who knows your product line and knows your industry. So she talks about this really perfect distributor that she's found and how she was very excited about it. And this distributor was very excited about this company. And it was going to become a partnership. And my clients that are great at international view their overseas distributors and the overseas parties as partners. And we're all in this together, right? So she was getting to know them. One of the things that the overseas distributor was interested in was terms, because they were clear that they really felt that they could ramp this business up pretty quickly to $100,000 a month, right? So this is a bit of a home run, $100,000 a month. That's in theory $1.2 million for the year. So this was a really potentially a great success story. And the distributor was looking for 90-day terms, net 90-day terms, okay? So that's quite a bit for a lot of my clients. That's pretty far out there, and issues go with that. One of the things that we want to do, though, is stop and understand our overseas partner and think about what their situation is and why they're asking for net 90-day terms. So when you look at overseas distributors, this particular distributor, their reality was, and remember they're in Brazil, so their knowledge, and they've done this before, clearly was that they would place the order on day one. It would take 2, 3, 4 weeks to get to Brazil, 2, 3, 4 weeks for them to get it into the market, and then 2 to 3, 4 weeks to get paid. So from the distributor's perspective, they really have a 60 to 90-day cash flow cycle beginning to end to getting paid. So that's an issue for a distributor, and they're looking for terms to match up with that. And there are a lot of reasons for that, actually. Most distributors really demonstrate a number of things pretty consistently. A lot of distributors are thinly capitalized, and that means their balance sheet and where they are means that cash is very important to them. So they tend to be thinly capitalized. A lot of overseas distributors, especially where your best growth opportunities are overseas, will tend to exist oftentimes in high interest rate markets and also markets that demonstrate a lack of financial liquidity. So we see high interest rates, lack of liquidity, thinly capitalized. What does that all add up to? Well, if we ask this distributor in Brazil to pay $100,000 up front, so if we insist on cash in advance, right, up front, then it won't be, it's a 90-day period to which they get paid for product. So that's $100,000 tied up in this product line, pardon me, for this distributor, right? And that's a big deal. We kind of think in terms of, well, that's their problem, right? And they should just finance that. A lot of times it's not so easy to arrange financing for distributors in an overseas market. And if they achieve that, it'll almost always be at a considerably higher interest rate than interest rates in the United States. So this becomes an issue for an overseas distributor. And it's not only the overseas distributor's problem, it's our problem as a company. And we'll see that here in a minute. Let's go back a page. So that's where we are with the head of international sales. Great market, great distributor, looking for 90-day terms, home run, can do $1.2 million for the year, right? So the credit manager is there listening to all of this. And again, he's a seasoned pro, very good at that function. And he speaks up and he says, well, this is great, this is very exciting, but my job as the credit manager is to help the company prudently manage risk issues, right? So, and from my perspective, I have two things that I'm focused on. We need to get our arms around and understand the risk issues with Brazil and also the creditworthiness issues of the Brazilian distributor. And when we talk about creditworthiness, what are we talking about? We're talking about the ability and willingness to pay an obligation. So this is the credit manager's perspective. He was well-staffed, well-resourced, great at this function, and he was prepared. So he proceeds to tell everybody, look, we've gotten our arms around Brazil. We clearly talked to the Department of Commerce and others. This is good. We can be in Brazil for sure. On the distributor, we've actually run a credit report on them when we talked to others in the industry, and we like them. We think look like maybe they could be a good partner for us. But we are really all about best practices, best industry practices, right? And when we look at the numbers and the credit reports and what we're talking about, best practices really suggests that we extend net 30-day terms and a $100,000 credit limit, not net 90-day terms and a $300,000 credit limit. Let me walk you through the $300,000 credit limit. I think I missed that on the last slide. If we move ahead with this distributor and they want 90-day terms and it's $100,000 a month, what does that become? We ship $100,000 on day one. 30 days later, we ship another 100,000. 30 days later, we ship another 100,000, right? So all of a sudden, we've got $300,000 outstanding in Brazil, open account. Then 30 days later, we're finally at net 90, the terms they want. And in theory, they would pay us 100,000, then we would ship 100,000, so forth and so on. So this business with net 90 at 100,000 a month would ramp up to a $300,000 average exposure over time for this company, right? So that's a big issue. So the credit manager says best practices really doesn't get us to there. It keeps us at net 30-day terms and a $100,000 credit limit. So we're really bumping into an issue now with our partner, and this is important for our distributor, okay? Well, the CFO is also listening in on this, of course, and she also super talented, really great at finance, and she speaks up and she says, look, I'm excited also about this opportunity. This looks really like a home run, but if you're telling me that we're about to be pursuing more and more overseas markets and extending open account terms, that means our foreign receivable base will be growing. So we're going to have more and more money outstanding to overseas markets, foreign receivables, right? And she said, I've already talked to our bank. This does become a cash flow issue for us at some point. And I've talked to our lender, and our bank is not wild about foreign receivables. So, and they're not interested in financing that. So we don't have a financing solution here for these foreign receivables. So, and is that true? So for everybody in the audience right now, You might be aware of this, very, very possibly, but it's true. In fact, domestic banks are not wild about financing foreign receivables at all. Most US banks that I'm aware of don't finance foreign receivables unless, you're right, exactly, you guessed it, unless there's an Exim Bank program backing those foreign receivables. So at this point in the story, the CFO is correct. Big financing issue here for this company. I mean, we're pursuing international why, right? We're pursuing it because we want it to become something, we want to get traction, we want it to take off and become more and bigger. Well, by definition, if you succeed and you get traction, you're going to have growing foreign receivables. And for almost all of my clients, at some point, usually sooner than later, we're bumping into cash flow issues on our side. And we really want the flexibility to finance those foreign receivables. People ask me a lot, they say, well, why is it that US banks don't want to finance foreign receivables? You know, are they just not, they just don't get it? They don't know international? And no, of course not. Bankers are super sophisticated and know international just fine, a lot of banks, that is. And the issue really is a couple of things for US banks: bank regulators and a board of directors, okay? So in this story, if this company's bank provides financing on $300,000 of foreign receivables, and then a week later, a bank regulator comes in and looks at the bank's books, the bank regulator will say, what is this? You know, it looks like you financed $300,000 of foreign receivables. And if the bank has nothing to say about that, then they take a hit with the regulator, right? So regulators are all about reserve requirements, capital asset allocation ratios. The list is long of all the metrics and the things, but a foreign exposure means that a bank takes a bit of a hit. And banks found out a long time ago that they don't need to do that. They can get Exim Bank support. And then when a bank regulator looks at that on a bank's books, it's no longer a Brazilian exposure if it's backed by Exim Bank. It kind of turns into a domestic exposure and even just a US government exposure. So that's very different from bank regulators' perspective, right? And then the board of director issue is, as always, a board of directors they tend to be very risk adverse. Okay, so they're not looking for exposures and things that can be problematic down the road. So that's a bit about the banking issue. But she's correct. That's a big issue for this company at this point. So that's kind of the lay of the land. Great head of international sales, found a great opportunity. We have a really good distributor, good opportunity, a credit manager keeping us honest and staying on best practices, right? And a CFO with finance issues on her mind. So the CEO of the company then addresses everybody. And as you would expect, the CEO's position is, look, congratulations, head of international, fantastic. This is a great opportunity. Super job, credit manager. We really respect and appreciate that you've helped us dodge the bullets over the years and kept us in a good place. And I really understand what my CFO is saying here. We do have a financing issue, but we're a company that's about growth. We need growth. We're looking for growth. So we really need to pursue this opportunity. Let's do this. Let's pursue this opportunity. Let's go with best practices and we'll try to make it work, right? So that was their approach. And when you apply those best practices to the situation, let's walk through that together. So you end up with a lot of things happening, but let's walk through it together. On day one, we ship $100,000 of product to the Brazilian distributor, right? 30 days later, the Brazilian distributor calls and says, we're ready for the next shipment. The pipeline's ready, we have interest, we really can move this product. The credit manager jumps on the phone and says, well, wait a minute, let's be clear about this. We thought we were clear. We're really gonna stay with net 30 and $100,000 credit limit. So you've got 100,000 outstanding and it's actually due. So you should be making a payment. The Brazilian distributor says, we haven't been paid yet for the product. So that's the end of that conversation. So then another 30 days passes, we're now at 60 days. The Brazilian distributor calls again and says, we're really ready for product now. We really got the pipeline ready. There's an actual, truly a demand. We can do this. The credit manager jumps on the phone again and says, look, we're adamant about net 30 and $100,000 credit limit, okay? And now you're 30 days past due. Now you really need to make a payment. The Brazilian distributor says, we're sorry, but we haven't been paid. We're not able to pay you, okay? So then over the next 30 days, as we're approaching 90 days out, what's going on? Well, you've got a lot of things happening here. You've got the Brazilian distributor who has been expecting product, has built the pipeline, is ready to go, not getting product. So they're not happy about the situation. You have a credit manager who says, we have $100,000 outstanding. We've been clear about the terms. They're way past due. This is frustrating. Not a good buyer. We're not happy about it. And they've blown my aging out of the water. So a credit manager in a company, rightfully so, considers their aging very important. It's a very important thing for management purposes, for investor purposes. Your bank cares about your receivable aging, okay? So this is a big deal, and the credit manager is frustrated by this. And the credit manager is now sending irritating phone calls and messages to the Brazilian distributor. You need to pay us, you need to pay us. And that's irritating the Brazilian distributor, not happy about that. What about the CFO? Well, the CFO's position is, look, we talked about this, but now we have $100,000 outstanding. I do not have a financing strategy for that, so I'm having to manipulate our numbers a bit and manage this. It's a frustrating issue for the CFO as well. Where is the head of international during this period? I see this all the time. When a company has a problem with the overseas buyer, we kind of turn to the person who should have that relationship. So we turn to the head of international and we're saying, look, they're way past due. You call them, let's get them going. We've got to fix this. So the head of international is embroiled in this bit of a mess and taking time away from her looking for the next Brazil. And by the way, who wants it? I mean, look at this. We have a Brazilian distributor who's not happy. The credit manager's not happy. The CFO is frustrated and not happy. The head of international is bogged down in this too. So it's like not a good start for international. And remember, when we talked about $100,000 a month, that could be $1.2 million for the year. But in this scenario, we're talking about only periodic shipments, and it's looking more like $400,000 a year instead of $1.2 million. So here we're going to do a trickle of the business that we could potentially be doing. Okay, and nobody's happy. What's the company's risk? That's $100,000. They've shipped $100,000. It's out there. They're waiting to get paid. So here we have all of this going on and a bit frustrating, and it's not really a good start for the company. That's when we really became involved with the company and talked to them about the possibility of an export credit insurance program. And they agreed to take a look and to pursue this. We went to Exim Bank and we applied for a program for this company. And we said, Exim Bank, we'd like your multi-buyer program because this company is going to grow. So we were looking for a program that could expand to include more markets and more buyers. And we were also clear with Exim Bank about the Brazilian situation. And we sent Exim Bank a credit report and the information about the Brazilian buyer. So Exim Bank looked at all that and came back to us and said, yes, we will do this. We'll give you the program and we will support the business to Brazil. And the fundamental concept of this Exim Bank program is that when they agree to support something, they will protect my client against non-payment. So very powerful concept. We now have a program with Exim Bank, and now my client is protected against non-payment. All right, so now what happens? Let's walk through it now with the company not on its own, even though they're amazing, they're no longer on their own. They now have a partnership with Exim Bank. Let's walk through that step by step. So on day one, now we will ship $100,000. 30 days later, we ship another 100,000. 30 days later, we ship another 100,000, right? So we're ramping this up to $300,000 outstanding. That's a lot. Well, the Brazilian distributor is happy, right? They're getting product every month and they're building that market out there and it's going great. What does the credit manager say? Well, the credit manager's position is, okay, I'm good with this because our partnership with Exim Bank protects me. I know that Exim Bank is covering 90% of this for us. So even though we have 300,000 outstanding, our real risk is only 30,000, okay? And all of a sudden now, under this scenario, the Brazilian distributor is paying every 90 days, just like they said they were going to. So they're paying timely. So the credit manager looks at that and says, that's great. My aging is good. This overseas distributor is performing well. I like them. They're a great partner. We love them. So from not being happy about the distributor to now saying they're a terrific partner for us, okay? What about the CFO? Well, before, with $100,000 outstanding, it was frustrating and the CFO was, pulling her hair out and not happy. Now we have $300,000 outstanding. And the CFO's position is, okay, again, with our partnership with Exim Bank, I've arranged with our bank, and they're fine, supported by Exim Bank, including these foreign receivables into our borrowing base. So our financing strategy here is set. So we're good. So the CFO is taken care of and happy. What about the Vice President of International Sales? Well, instead of being bogged down in fixing the mess in Brazil, there is no mess in Brazil. The VP of International is out there moving ahead to find the next Brazil. And who wants it? Everybody. So this is great. So international looks good. Everybody's happy, working really well. What are the total sales that we'll do this year with Exim Bank as our partner? We're going to do $1.2 million, right? So instead of the trickle of not doing enough, we're going to get there and actually have quite the home run, right? What is the company's risk? On their own, the company had $100,000 outstanding and lots of problems. They were holding a $100,000 risk. With Exim Bank as their partner now, their risk is only $30,000. By the way, a little side note, the coverage usually with Exim Bank is 95% typically. So their risk probably was only $15,000. So we've really dramatically taken care of the risk issues here. So that's the before and after picture. And I always really try to stop and focus in on talking to people about what this story is about. Remember, this is a story about a company that was adamant about growth and about we're going to find new markets, new buyers, or more with existing buyers. That's always true. And so it's about growth and doing more. That is what this story is about. Along that path, during that journey, they bump into risk issues and financing issues. But this story is not about risk and financing, it's about growth. And our partnership with Exim Bank is one of our most amazing tools to help us with growth, okay? Interesting statistic, 80%, they estimate that 80% of European companies utilize the equivalent of an Exim Bank program, 80%. They estimate that number in the United States to be between 8 and 10%. So 80% in Europe, 10% in the United States. This is an incredibly underdeveloped, I believe misunderstood strategy that is so important, okay? We have not only Exim Bank, we have other private sector underwriters. So we have probably 8 or 9 private sector underwriters in the United States that have comparable programs to Exim Bank. And we are with Exim Bank for a variety of reasons, but Navitrade's first job is to understand a client and find the right underwriter in the best place. But especially for smaller companies, you just can't beat an Exim Bank program. We can get it in place in 2 weeks, no upfront fees. It's pay as you go. Think of it as 0.5%. So if you do $100,000 in this month, we would report that and pay $500 to Exim Bank the next month, right? Pay as you go. There's no minimum, okay? And it's such the low-hanging fruit, and we can do it fast, and it's a very powerful mechanism. That is really the important story that I really love to share with people, and I hope you walk away from this thinking about, growth. You need to do 3 things when you're pursuing international. You need to find opportunities, and we can do that through the USIAC, the United States Export Assistance Center, and Other groups, states usually have their international trade centers, and they're all about helping you find opportunities. Then we need to understand how to export. We need to become export ready and understand the nuts and bolts. And there are organizations out there to absolutely help you do that also. Then the last piece of the equation is execution. So that's where Navitrade is hanging out a bit, and that's our focus. I see companies all the time that have an opportunity and they have the nuts and the bolts down, but the opportunity is kind of sitting there languishing. Then we put in place an exit bank program and it really takes off. So that is my quick story, and thank you for letting me be here. I love talking about this and would love to have any questions from anybody in the audience. And you can always contact Navitrade, navitrade.com, and we would love to talk to people. So with that, I will hand it back over to Heidi and Rudy, and thanks so much for letting me be here today.
Very good, Brent. That was a great story, and I think it really hit all the different points. You know, you mentioned that there are entities out there that help people with exporting and trying to discover what countries are best suited for your different companies. Obviously, the Arkansas District Export Council is one of those entities, and Arkansas Manufacturing Solutions, in the form of Arkansas Economic Development Commission, has an export tech program whose goal is to help you develop a strategic marketing plan to identify the appropriate markets for your products and services. So we definitely are here to be able to help you in any way we can to try to expand your export markets. I also wanted to mention that probably many of you have seen the news the last couple of weeks and been aware that there's a ship that's called the Ever Given that got stuck in the Suez Canal and just really caused quite a debacle. Now, the insurance that Brent is mentioning right now, it doesn't cover what happened with the Ever Given, but do recognize that these sort of problems, storms and fires and any number of things can occur when a shipment is sent, especially by ship, right? And you know, they've got these humongous ships that have all these containers, and so in the case of situations like the Ever Given, if your products were being sent on this particular ship, you have a multitude of problems. Obviously, you know, the letters of credit, if you're using a letter of credit, stipulates very specifically that it has to be delivered within a certain time frame and all of that. And if you were like the Ever Given right now is still stuck in the Suez Canal. I mean, not literally stuck, but they're not being allowed to leave until they pay $1 billion in damages. But you know, you're going to be impacted by that, and the ship line is not going to cover that that loss. And so the other thing that is kind of adding insult to injury due to historical things that have occurred over history in terms of shipping, and that is that the ship line is actually going to charge you for their losses. So instead of them paying you, you're actually going to pay them, even though they didn't deliver the product on time, even though they screwed up, or they threw your products overboard because of a big storm, or they caught fire. You're actually going to pay them for their losses. So who's going to pay for all these different things? Your product not arriving on time, you're losing the sale, you're losing your product. Well, so a ocean marine insurance is a type of insurance that covers that sort of stuff. And so, you know, this whole series of webinars that we've had the last 2 weeks have been about risk mitigation and finding instruments that are out there to try to mitigate your risk so that you can feel more comfortable in doing exporting, because should something go wrong, you're going to be covered. And so, you know, Brent's talked about these different export credit insurance instruments that are out there. This ocean marine insurance tool is something else to be able to cover the physical losses of the type that I described. So all of that to say that there are instruments out there to mitigate the risk, and you shouldn't be afraid to increase your markets, your foreign markets, due to concerns about risk, there are instruments out there to help you mitigate that risk. And we here at the Arkansas District Export Council and the Arkansas Manufacturing Solutions are here to help you in any way that we can to expand your export markets and help you identify what they are and answer any questions that you have about how to do that effectively and efficiently and profitably. Anything else, Brent?
No, Rudy, you mentioned a letter of credit. Just really quickly on that, people use a letter of credit sometimes, and that's the right thing to use. But a fundamental reason we do a letter of credit is risk issues. And letters of credit require fees on the buyer side, fees on the seller side. They're an administrative burden for sure, and they're not bulletproof. Absolutely not bulletproof. And so my clients, also the other thing too, on a letter of credit, that impinges the buyer's borrowing capacity. When you open a letter of credit as a buyer in Brazil, you go to your Brazilian bank and your Brazilian banker says, oh, 100,000 US? Okay, we have to put $110,000. You have to typically over collateralize the transaction to take care of possible exchange rate risk issues. So you have to over collateralize upfront the transaction. It's worse than cash in advance for a buyer. So a lot of companies really prefer and move to an export credit insurance program, with that being one of the reasons that a letter of credit just doesn't work for overseas buyers, and they really don't like them. And we can get the same things done through export credit insurance, just as a quick note.
Perfect. So, as it turns out, one of our participants has a question. In satisfying the 51% US content for XM, can you combine a machine that was made 100% in the US with a second machine that was made 100% in Mexico?
That is a really great question. And what we have to do is tear it all down and present that to Exim Bank and make our best argument at the end of the day. That's a tricky example that you're throwing out there to me. And depending on your situation, we can either sometimes get Exim Bank to cover the whole invoice for the whole thing, or they might say, no, you have like two separate items. We were going to cover this item and not the other item, even though they're on the same invoice. That's a tricky issue, and we've looked at that many times over the years. The best thing to do is to break it all down and to present it to Exim Bank and go with our best arguments. There are lots of examples that don't work that are easy. If you import $100,000 of video cameras from Japan, and you slap a label on it and want to export it to Mexico, obviously Exim Bank says, well, no, that's creating jobs in Japan. We're not supporting any of that. On the other hand, if you were to import, let's say, $10,000 of raw wood from Mexico and bring it up here, and an artisan turns it into beautiful artistic chairs, well, I mean, on the one hand, 100% of what it is wood from Mexico. So you'd say, but in fact, the value added proposition of the artist who then sells it as something else, even though the actual content was 100% foreign, what you end up with and the value added and the work effort that went into that happened here in the United States, and we will get that type of thing typically 100% covered by Exim Bank. So I would say that's a great question, and it's a little bit tricky territory that is a bit frustrating. And the answer is we've got to break it down and present that to Exim Bank in detail and make our best arguments.
Yeah. Okay. So Brent, you're actually saying that there's no absolute yes or absolute no for this kind of situation. You make your best argument with XM and they make a judgment on that. Is that accurate?
Well, the person who asked the question was correct. Exim Bank's mandate, and it goes back to the history of the formation of Exim Bank. Exim Bank was created a long time ago. Their mandate from Congress is to create US jobs, right? So they've determined that Well, some things don't have all US content, but the majority of it should be. So 51% is the point. Exim Bank says, look, we need at least half of that product to really be anchored here in the United States and creating jobs. So the question, and that part of it is correct. We have to achieve, from Exim Bank's perspective, a 51% US content. How that might work kind of varies a bit. So you might end up with an invoice that has a lot of things on it. And there are times when we can get the whole invoice covered, and there are times when we'll get just a portion of the invoice covered. But it's a kind of a case-by-case situation that we have to present everything. And but it's a great question.
All righty. Well, we'll try to dig into that a little bit deeper offline and see if we can get an answer, that maybe is a little bit more cut and dry. But in any case, appreciate the question. Brent, do you have any parting comments?
No, I just think that people are so right to step back and say, what is our future, and why can't a part of who we are moving forward, can we find another 5, 10, 15% additional revenues just from overseas? And the answer for so many US companies is yes. And if you're new to export, just know there are organizations there in Arkansas that are all about helping you find those opportunities, helping get you export ready. And then underwriters like Exim Bank, they're gonna help you execute those transactions, get them financed, and protect you. So it is a package waiting to be explored by US companies, and it's overwhelming, and yet these teams of people really can get it done for you. And all of a sudden, a year later, you're gonna be excited, and international is very important for US companies. So.
Well, you said, can you get another 10, 15% in revenues? Well, obviously the answer is yes, because of many foreign countries, 100% of their revenues come from exporting, right? And so
Sure.
that's
Right.
why they're in Europe. They're using 80% of the 80% of the companies are using insurance, because a significant portion of their revenues, in fact, do come from exports. So absolutely, you can increase your revenues by exporting, and it has a lot of other benefits when you do exporting. In addition to gaining revenues, you increase your buying power. I mean, if you're increasing markets, wherever you're increasing markets, you now have you're buying more parts, more materials, which increases your ability to negotiate a better pricing structure with your vendors. So there's just a lot of things that you can do that are beneficial related
Right.
to exporting. Well, very good.
Absolutely.
Unless someone has an additional question, I think that you do. Oh, okay, hang on. Let's see, it looks like we do have. I'm trying to see it. Heidi, why don't you go ahead, because I'm not seeing the question.
Yes, just the question, will we have access to the recordings of previous sessions in the series in addition to this one? Yes, sir. We will be sending out those recordings and all the PowerPoints. I'll send them all out via email by Monday at the very latest. Hopefully by tomorrow, you will have all the recordings and all the slide presentations in your email box.
Perfect. And of course, obviously, we recognize that this has been a lot of information. All the 4 webinars that we've had, lots of information. If you were good enough to have attended all of them, there's really no way that you could have written down all of the information. So we want the videos and the information, the slide decks, to act as a resource for you to be able to go back to, time and time again, to try to extract answers to questions that you have. And once again, if you have any questions, despite that, if you have questions, please feel free to contact us. Ms. Heidi, would you go ahead and give people the information at the slide? All right, so there's Brent's web address or email address, and there's the Arkansas District Export Council. That is our website, and it is very, very comprehensive, has tons of information that anybody who's interested in expanding their export markets can go to and get just great information. I happen to be the current chair of the Arkansas District Export Council. There is my email address, and Heidi's the administrative coordinator and the person that makes all of this work. And there is her email address. Please feel free to contact any or all of us if we can answer any questions at all. And with that, we will call it a day. Thank you so much. You guys have a great day.
Thank you.
Okay, Brent, thank you.
Thank you, Brent.
Thanks, Heidi. Thanks, Rudy.
Yes. Talk to you again soon, we hope.
All righty.